Hello, I'm John Dougery, one of the founding partners at Inventus Capital. I'm here with my partner Manu. Um, we're a part of a team of 6 people that have been in technology for a long time, initially on the front lines of many startups and leading Silicon Valley companies. And in recent times, as venture capitalists backing entrepreneurs building the next generation of services-led startups. Also joining us today is Andrea Chang, who will be moderating it for us. Leading the discussion. She's a technology reporter with the Los Angeles Times and a graduate of the Medill School of Journalism at Northwestern. Last but not least is Manish Chandra, the CEO of Poshmark. Poshmark is a mobile fashion marketplace that allows people to buy and sell fashion. And we've backed Manish in many startups, and Poshmark, as I think you'll hear, is really on a tear. So from an agenda standpoint, for the first 20 or 25 minutes, Andrea will be asking us questions about the overall tech startup landscape and what to watch out for. And during that time, we'd ask you to write down your own questions for us in the video box below. And you can upvote and rank and force the ranking of those questions, and we'll hope to get to as many of them as we can for the remainder of the session. So hopefully that's clear, and we'll now hand it off to Andrea to take it forward for us.
Great. Thank you, John, and welcome everyone. Thank you for watching with us today. I just want to start it off with a quick question for Manu. Wanted to ask, what are some of your predictions for investing trends in 2015? Are there certain tech sectors that you're especially interested in right now?
Absolutely. When you look across the board, we always get excited about entrepreneurs that surprise us. But to go specifically into specific sectors, I've been really excited about marketing technology. MarTech is sort of enabling marketing teams and CMOs to actually take control and be able to reach consumers and have technology infused in it. For the longest time, the holy grail of marketing has been one-to-one marketing with consumers. But as everybody knows, 50% of the advertising might be wasted. You just don't know which 50%. And as technology and marketing has improved, CMOs can finally take control and be able to sort of achieve that holy grail. So we see quite a plethora of companies and activity in the space. Just to sort of give you an overall perspective, about $1 trillion gets spent by brands every year, and less than 1% of that budget actually goes to technology, right? So we expect that number to almost grow tenfold the next 10 years, and you can see the large-sized companies that can be created in the process of doing this. I'm just to give you an example, Google basically created an empire based on this exact thought, to be able to connect consumers to brands without all the clutter in between. And one of our companies, for example, Dougery out of Bangalore, has a global footprint, helping companies retarget customers that already have an attachment to them. So that's one area that we're really excited about, and I think this is not just us, but across the board. And the other one we're really excited about is social and mobile commerce. And just to give you a perspective, about 5% of retail happens online. And that number is going to double in the next few years. And a lot of it is driven by smartphones and social commerce sort of finally taking hold. And 50% of this happens through word of mouth, with customers recommending other customers. And Poshmark is one of these companies that has done an amazing job leveraging both mobile and social. And I wouldn't have Manish actually maybe even talk a little bit more about this as well.
So yeah, absolutely. Thanks, Manu. Thanks for the handoff there. First of all, just wanted to thank Inventus for inviting me to be part of this conversation. Can everyone hear me?
Yep.
Good.
Okay.
Yes.
Great. We're a mobile fashion marketplace, but really the two unique things about Poshmark is 3 years back when we started the company, we bet 100% on mobile. We started our life as an iPhone app, which was really swimming upstream back in 2011. And then the second thing is we bet the entire marketplace in a very social architecture where all of the discussions, commentary, interactions are really social and out in the open. And that was also against the grain of private messaging and sort of what was happening at that point in time. 3 years later, we just announced in December that we crossed $100 million in total volume on the platform. Since then, we've grown another 50, 70%. Today, roughly every 10 days, the equivalent of a Nordstrom store gets uploaded on Poshmark by our community. Our average community member spends somewhere between 20 to 25 minutes a day engaging with the platform. So really what you see at the cusp of social and mobile and commerce is that driving that repeat engagement over and over with the customer is super critical. But then also being able to seamlessly turn that into a transaction is equally important. And then keeping them coming back is what really ultimately makes that mobile experience successful over time.
Continuing on that idea, can you talk a bit about some of the challenges that you face getting this startup off the ground? I mean, you're in a really competitive area with social, with shopping. So what did you do to make your product, to make your brand stand out from the crowd? How did you go about securing financing and just getting the word out there about Poshmark?
Sure. I think for startup, particularly this one and the previous one, sort of in the early days, it's really about the team formation and really thinking through how do you put together that fantastic team. And the team is made up of both the people which are actually part of the core employees of the company, but also the investor group that sort of puts and backs together, because the combination really helps drive that initial growth and intellectual property and the capital within the company. So having had the benefit of having a successful startup under my belt with Caboodle, and actually Inventus was one of the lead investors in that company. When it came to Poshmark, I had quite a few choices in terms of how to configure the investment, and ended up choosing a couple of investors, some of them who were part of the Caboodle experience, some were new. Inventus was one of the key partners we chose to kind of really work with and bring into Poshmark, together with Mayfield, who was also a lead investor in Poshmark. And in the founding team, one of the things I wanted to do, even though Caboodle was in the fashion area, the core founding team really didn't have the fashion DNA. So here, besides the technology DNA, I worked very hard to really recruit a co-founding member, which is Tracy, who comes from natively the fashion world. So that was sort of the foundation of the company. And then the other thing we did was when we were working in the initial phases of building out our community, we really wanted to make sure that the first 500 or 1,000 people who joined the platform really were deeply engaged. So we spent almost a year perfecting the platform, iterating through it, and had only 500 members, but they were all active users, buyers, and sellers on the platform. So that's sort of how we got the company started and off the ground in the early.
Thank you. And John, from the VC side, can you talk a bit about what are some of the stumbling blocks that you've seen when startup entrepreneurs come in and they try and pitch you? Talk about some of the mistakes that you've seen, and then some advice or tips on things that you like to see.
Sure. I think that one of the things that we often see is entrepreneurs who are extremely confident. You have to be to leave a job and start a company, and probably eat beans like we did starting Inventus for a year or more before you get financed. And it tends to lead to a trap of thinking you can do it all. And I think you can do more than you really can, or you can learn faster than the normal person, which usually most entrepreneurs can learn faster, but maybe not fast enough. And so one of the biggest things, one of the biggest problems is building the team, with A+ talent from an early stage, and being really focused on that as a core competency, not on just building the right product or listening to your customer, all the other things that are so important. We see this at the seed stage. We see this, at every stage of a company. Recruiting is very difficult, and it takes a lot of time. It's very easy to put it off, and so that's one of the things we try to impress upon the entrepreneurs we work with and help them to do, is really to bring in the right talent.
You talked
frankly,
about
earlier is always better than later.
I hear this a lot, that the team is the most important part of a startup. And can you be more specific about what qualities should you be looking for in your team members, and how do you go about finding the right people?
Absolutely. Yeah, I mean, it is almost trite to say it, but it's actually so much more important now than even 10 years ago or 20 years ago when we're starting companies, particularly the kinds of companies we work with, like Manisha's company, which are completely human capital driven. There's a lot of technology there. There are a lot of companies that can build technology, but it's software. A lot of people can do it. The real differentiator is the human element, and so we really encourage people. We want a founding team, a composed founding team, as Manisha's outlined for his company. But then you want to bring on people who also can share the vision, share the level of commitment, but also bring the level of experience that you need. So often one of the traps is that, particularly when you're a young company and you don't have huge amounts of money to throw around, you think that you have to hire more junior talent than you otherwise might. And one of the things we look for is hiring people who are domain experts. They may not be expert in the new type of business. Generally, it's a new type of business. But as Manish mentioned, they come from the fashion industry if you're building a fashion company. If it's going to be marketing technology, like Manu mentioned, then it should be someone who's come from that kind of background. So we call that athleticism. You want athleticism for the position players, the leads for the various functions, whether it's sales, marketing, etc., in the company. And you really want to filter through that to look for people that are very, very focused on building value for the company. So they're focused on the equity in terms of their compensation. They're not just solely thinking about a paycheck. And so, finding those types of people and sifting through the universe is generally a networking. That's why you want to have the right network of people around you early on in the company to help build it, because you're generally going to find these people through through your networks.
How do people find you? They're interested in sitting down and talking about their startup. What is the best way to approach you? And how many meetings do you take a week with new startups, and what is the rate of companies you'll actually invest in?
It's daunting. Since we started Inventus, 8 years ago, the number of companies we've seen has more than doubled. Part of that is our brand is more recognized, but I think also the environment is, a lot more people willing to take the risk of stepping out and starting a new company. And so getting attention is harder than it's ever been in this cycle. I'd say probably harder than it's been since, 99, 2000. And it's always been the case that the way to get the attention of the best investors is to do so through their networks. Find a way, and it's so much easier today than it used to be, right? Whether it's through LinkedIn or Facebook, or find out someone that's some degree of separation away from that investor. Those are the meetings that we always take. If someone we trust introduces us, we're going to take that meeting, regardless of whatever focus that we have, as long as it's within the scope of kind of services-led software companies that we like to focus on. That meeting is much more likely to happen. Cold calls and cold emails, cold approaches through LinkedIn is what so many other people do. And last year we saw over 1,400 opportunities to invest, and we make half a dozen to a dozen decisions a year. So to get above that, those numbers, you really need that kind of warm introduction.
Manu, are there specific startups right now that you're especially excited about, and what about them made you want to invest in them?
No, absolutely. One of the key ones that I'm been excited for a long time is Poshmark, Manisha's company. And part of the thing was, in terms of how the industry and how consumers were actually switching and using smartphones more and more. And a smartphone has eyes and ears, the camera, and be able to sort of display things easily. So it makes it very easy for someone to take your cell phone and take a picture of your closet and then put it up online. Now take the same thing with eBay. You take a camera, download to your laptop, edit it, bring it back up again, and so the friction is too much for that transaction to happen seamlessly. So there was a fundamental shift, that would improve the way the current process was happening by at least a factor of 10. And we look for things like that actually improve the technology can dramatically improve things from the status quo. and companies like Poshmark, did that. So we were very excited about this and invested in Poshmark, when it was just basically a business plan. And the other part was a team. We had known Manish from a previous investment, and his ability to sort of attract some of the best talent around him, right? So there was that piece, and and there was a lot of hunger in him as well. So I think there's a combination of those three that allowed for that investment to happen. So we've been excited, and both from a market size and also from the team that Manish has put together. So that's one example. Another, we also invest in India as well. So we've been looking at, there's 1.3 billion people in India. Asia is a large economy overall. So not everything is insular within the U.S. So just like firms have to sort of sort of find their niche and do well. There's dozens of VC firms on Sand Hill and the Bay Area. So we've actually had that insight of being able to diversify in India. And as India, our thesis was that India was about 10 years behind China, and that has been panning out. So when the firm started, in 06, so we were wrong by 1 year. We were expecting this thing to start tickling off next year, but you see the dramatic sort of change in environment in India, and it's a combination of the ecosystem taking hold, but also the governmental policies and the change in government that has made a dramatic shift in perception. People are people anywhere. So somebody being in Bangalore or Bombay or Beijing, Shanghai has the same aspirations as somebody sitting in Palo Alto. So we're very excited to help mentor and fund companies in India that actually can provide the services and products that those people need. And the market's huge. So just to give you an example, we had a company that automated bus ticketing services. So if you wanted to go from point A to point B, even in the US, like when we had to go to Greyhound, Peter Pan, you had to go to tens of bus services to find which one would work. Now take the same problem and magnify that by 100 in India, where any person with a bus could could operate between these cities. But how, as a consumer, would you find if there's a ticket available? What time would the bus arrive? What the service level was? Are you going to be arrive at the other end safely? So there's a whole bunch of unknown information, and so this company is able to aggregate that information, provide that easily over the mobile. And in a short time, the company was doing double-digit $1 million in revenue on small ticket sizes. So, literally they were able to build a very large company on the bottom of the pyramid. So we see opportunities like this in India, and we have invested in across the board, whether it's in media or enterprise. And we see India as sort of a hybrid between China and Israel. It has, because it's English speaking as a background, the entrepreneurs that can compete globally, but they also have a large internal market that is starting to open up.
What percentage of the companies that are funded by you are international right now? Do you think that that's going to increase over time? Are you looking, you mentioned you obviously looking carefully at India. What about China and other parts of the Asia Pacific region?
So 50% of our investments happen to be in India, and there's two reasons for that. One is three of our partners are based in Bangalore, India, and so it's just a deal flow. How much time in a day do you have to look at these companies, right? So since we have three people here, three in India, 50-50 split. It just happens that the investments are typically 50-50 split. We don't go out. We don't have a fund that sort of splits our investments into those two halves, but it's just we're limited by our time to do those deals. But we get to look at all the best deals. We're the most prolific early stage investor in India, and so we get the chance to actually see most of them. Now, your other questions around whether we do investments outside of India, we're a team of 6 people. We have expertise in these 2 countries. We worked and built companies as entrepreneurs in these areas as well. So we understand the market space. To do something, to go invest in Malaysia or China or Japan would just be out of our wheelhouse. And so we haven't expanded, and we're not these two areas are some of the most target-rich opportunities, right? So if I was in the military, why would I look for other targets when there's so many targets available here?
It does seem that over time we're seeing tech really. I mean, it's no longer confined to just Silicon Valley, and even here in the U.S., there's all these tech clusters that are popping up everywhere. Seattle, Denver, New York, and me here in LA, all over LA. And I'm wondering for you, maybe John, if you want to take this question, are you kind of expanding your search beyond the Bay Area? What do you think the next hot area is in terms of location here in the U.S.? Looking in LA a lot? Are you?
Oh yeah. Yeah, your premise is, I think, absolutely dead on, and in fact, I think it's an accelerating trend. I mean, especially now when we talk about cloud infrastructure, services-led business models, lightweight self-service, customer adoption, even whether it's consumer or business. It used to be you needed to be near your customer because you were going to sell to them. You had a field sales force. That's rarely the case anymore, even for SaaS software. Most of it is sold over the phone, over the internet, or self-service. And so we're seeing best-in-class companies out of, say, Chennai in India that have a New York sales presence, and they're absolutely killing it with one guy, answering the phone on an inbound basis, not even doing outbound, because they're just solving a problem that is, hurting. People are hurting. You look at last year, cloud application deployments really took off, and so anytime you eat a new technology, you end up with a hangover the next year. And people have got a big hangover around securing their data in its cloud applications. Security has become something, a new renaissance around securing these cloud environments, and entrepreneurs are going after that. We as far as your question about San Francisco, LA, New York, Chicago, Seattle, there's an old trite expression about sandhill VCs. They don't want to go more than 30-minute drive away, let alone the East Bay of San Francisco. That's never been the case for us. We get on a plane, we go all the way to India every couple of months, and we're happy to see innovation happen in other places. We've worked even in Vancouver and places beyond. So we really don't have a geographic definition of what we do. We have much more of a business model expertise and a kind of a stage that kind of supersede pre-Series A focus for great entrepreneurs, and so we'd be happy to see more of that deal flow. But the fact remains that the Silicon Valley has just got this engine that's just ticking over at a very high speed. We just see so many opportunities here. We do see more coming out of LA. We'd be happy to participate in that, and we've come close on a couple occasions. But for us, we try and force rank it and as honest with ourselves as possible about picking the best entrepreneurs regardless of geography.
I wanted to turn it over. Oh, go ahead. Sorry. Go ahead.
So just a quick question, just to follow up. I mean, I lived in LA for 1 year, and you ended up meeting a lot of entrepreneurs, and there's a limited sector within Silicon Valley, between Hollywood and the beach. So you get to meet a lot of the entrepreneurs in a very short amount of time, right? So it's sort of like, if you take one city, Palo Alto, and sort of saying, that's the size of what LA is, right? So it's a close-knit environment, and you can get to meet a lot of the entrepreneurs. And I think that network allowed us to look at some more companies in LA as well. And I think the cost of starting a company in the Bay Area is continuously to go up, and whether you scale. If you're an entrepreneur here, you're looking to scale your sales or operations teams elsewhere, whether you go to Bangalore or LA, or your company in LA looking to do the startup work. So I think all these opportunities will continue to accelerate as it's easier and cheaper to start from anywhere.
Thank you. And I was going to turn it over to our viewers because they've been putting forth a few really good questions. Let's see if I can just put it here on the screen. All right. So can you guys see the question? I'll just read it.
Yes.
So obviously VC funding is once a startup has been off the ground. This question is for the individuals such as myself who are seeking pre-seed / seed funding, having no connections within the investing industry. What is the best technique to reach out to angels or investors such as yourself and getting a chance to see our decks? I've been on angel.co and making unsolicited calls to random firms to no avail. So I guess the overall question is for startup entrepreneurs who are feeling kind of frustrated by this process, how do they get their foot in the door?
Well, I think I touched on this earlier, and I guess to augment the point, I mean, when you're a startup entrepreneur, and very often it's a technologist, a really good technology entrepreneur that may not have been, on the front lines as a sales and marketing person. But when you're in a startup, you're always selling. You're selling people to join your company. You're selling people to buy your product. You're selling partners to give you things for huge discounts. You're always selling. And then of course you're trying to sell your stock to investors to give you the resources to go do it. And so getting access to those investors is an audition on your ability to sell. And and doing cold calls, as we all know, as anyone in selling would tell you, is the least productive activity to choose from. So you really have, and this is why, you have to get innovative and do your best to try and network through to find somebody that knows somebody that can give you some kind of introduction, because that's really just the best way, frankly, for any investor that's really active and seeing, a copious amount of deal flow to differentiate. When people find us through people that we know, we take notice because we say, we know that's not easy, and that shows an awareness of what it takes and a willingness to go do it. And that's that in and of itself is an act of differentiation from other entrepreneurs.
It would also be interesting to hear from Manish, given that he's raised money a few times, and you mentor a lot of entrepreneurs as well, to see what your experience has been.
I think really before you have enough proof points, the best people to raise money from are people who believe in you because they can really invest in you as an individual. And my philosophy in raising money is beggars are not choosers, choosers are not beggars. So if you have choices, obviously go for smart money. But if you don't, you take the money you get, and you got to pursue your dream and go forward with it. So it can be smart money, it can be money, but at the end you need cash to build out your dreams, and you got to take it to the proof points. So if I go back to my previous companies, or I go back to the foundation of many companies, sometimes the money can come from early customers, sometimes it can come from family, sometimes it can come from people you know in professional life who've seen you in action. Sometimes it's a little bit of money you put from your pocket, and a combination of that sort of leads to that first step in the journey.
Along those same lines, this is another viewer question I'm going to put on air. When should an entrepreneur give up on his or her ideas? Is John doing this first, and then we can, I guess, turn it over to Manish. Sure. Tell me if you've ever, after John takes this, Manish, tell me if there's ever been an idea that you had where ultimately you're like, I need to drop this. It's not going anywhere.
Well,
yeah.
Go ahead, Manish. Yeah.
Go ahead. I was just saying that there's been lots of ideas that you discard, but I think once you've sort of started a journey, there should be a fair bit of persistence before you start to give up on your idea, unless and until your idea starts to encounter resistance very early on. But I'd let John sort of maybe take a better perspective. I'm a big believer in persistence for a very long time before you can start to see some kind of fruit of your labor.
Yeah, I completely agree with Manish on that. I mean, you have to, you have to be tenacious, and it's not going to be easy, and you have to know that going in. In fact, the industry, or at least until recently, when it's become, a little bit easier, maybe just a little bit easier to get capital and get traction with an idea, because so many customers are more open to it now than they were, say, 5 years ago. People want to see you, show that perseverance, whether it's your customers, whether it's your investors, and they want to know that you're going to be there for them on the long haul, because they're making a long-term decision. Even your customers are deciding they're going to buy something from you. And so if you're trying to get a prototype and you're trying to get customers to help you with it, they tend to drag things out a little bit, almost on purpose, to see that you stick with it. But the lovely thing about this environment is that pivoting is a lot easier to do than it used to be. So you've got most companies are not hardware based, they're not infrastructure based. You don't need a big data center, you don't need all this stuff, and you can try out variants on your idea and A/B test, as we like to call it, figure it out. And that tenacity hopefully isn't too expensive. Hopefully, a few people iterate through and find something that's got some legs to it. But ultimately, it comes down to we often see that it comes down to the staying power of the team. And at some point, it can get to that breaking point. But we just can't sustain the bootstrapping methodology forever. And I think that the market's going to tell you, the customers are going to tell you.
And maybe I can give Lawrence a framework as well. So a good way to sort of figure out, whether you may generate 10 or 15 ideas before one may actually stick, and this is sort of expand what Manish was talking about. I found Steve Blank's sort of framework on product, market fit actually pretty useful for early entrepreneurs, right? So, so you have an idea, you go test it out. It either comes from a pain point you felt at the companies you have worked for, or talking to customers, and so you go test it out. The more customers you interact with, the more data you get back, the better you realize whether it's a pain you're solving or it's something that you think you may be solving, right? So that's one way to go figure things out. And you may have an completely out of the box idea that you can't talk to customers either. So there's a level of tenacity to be able to figure out how far do you go down. And at the end of the day, most entrepreneurs, to be entrepreneurial, you have to be a little bit crazy anyways. You do it regardless when everybody else tells you can't do it, it doesn't work, the failures are too high, you should stick with a job, and pay your rent, and you still do it because you feel, this is the best use of your time, and this is something you're passionate about. So it's really hard to argue with that, and failure is a good learning point, right? I mean, you learn more from your failures than you do from your success, and you may fail at the startup this time, but you'll have that much more learning to do next time. So my recommendation typically is don't wait around to figure out if it's not going to work, because odds are stacked up against you, but the successes are also pretty dramatic, right? And you will never know if it works unless you give it a shot.
Right, so we've got actually 3 questions from Kedar, all about Inventus and kind of just your investment method. So I'm going to put one of them up here. I'll read you the others. So we've got, at what stage of startup do you guys invest? What is your typical investment size? And what is the right team size that you typically look for when you invest? So basically, how big are these startups? Are they 2 people? Or are they 12 people by the time you usually invest?
Well, I can take that one. We like to invest. We generally don't do concept companies unless it's with someone that we've known before, like Manish. The bet there is completely on the team. In my experience, and I think in most of our experience, the initial concept is not the ultimate business. It will be iterated. So you can get excited about a general idea, but generally it's about the team and their ability to iterate and find the right, as Manu mentioned, product market fit. And in this environment, particularly in the areas again where we focus on services-led startups and software, it's not a capital-intensive business to start something. Generally, it can be 2 or 3 people who are very good at their domain and co-found the company, and they can iterate through that before they need capital from us. And so we generally come in when they've got a prototype. Hopefully, because they've got a prototype, they have some traction with customers. And we generally lead. We still believe in, regardless of what's always in the news about these big financings, which are generally much later stage companies. At the stage where we invest, which is kind of just before a true Series A, or just after a small seed round, it's a $2 to $3 million financing that we're leading. We generally do on half or 2/3 of that in a syndicate.
You said $2 to $3 million. You said you usually are invested for about half of that.
Half to 2/3 of that. Yeah.
Got it.
So, 1.5 to 2 million is our typical sweet spot. And there's exceptions to all these rules, but that's that's the general size. And then we reserve a significant amount of capital for follow-ons because we know that that's not going to be the first amount of money that good, successful companies are going to need.
All right, these are what's going on there.
Oh, and the team size.
Oh yes, the team size.
As Manish can talk about this one too, but he did touch on it earlier. We generally like to see at least 2 co-founders that have been working together and collaborating on the idea for some significant amount of time.
Why 2?
Well, 1 is hard. It's a very lonely, and again, I think Manish could talk, more credibly about it. But even in starting our own firm, there were 2 of us that started it. We brought on a third. It was a 3-legged stool, which is pretty stable, and it took us 2 years and a lot of blood, sweat, and tears to get it done. And without the support and continued, mutual confidence, this goes back to when to give up. There were many times in starting our firm that we almost gave up. But you stick together because you committed to each other and you figure it out. And generally, that tenacity comes from a group effect.
All right, our next question is from Eric, who asks, are letters of intent from customers who use or buy a software or service sufficient enough to raise a seed round in order to use that money to then build out the technology faster? If yes, is there a standard for the number of LOIs, size, industry diversification, etc. required? Manu, you want to take that?
Sure, I can take that question. Yeah, I mean, so this is a very generic sort of piece. I mean, the answer could be maybe. I mean, it could be yes or no, depending on what product or service this person's doing, right? So we typically like to be able to talk to the actual customer. LOI is a very good sign that somebody is willing to pay for pain that you're willing to solve, right? So that's a very good start. We want to talk to the customer to really understand whether this problem that's being solved is generic across other companies in the space as well, or is very unique to this one customer, right? So are you building a product versus service? Now, there are VCs that will fund services companies. We're not one of them, right? But the way we would look at this, and I can comment on other firms, is it's a good proof point how scalable it is. What's the market size? Is the pricing correct? Are you going to be unit economic profitable building the business, based on the problem you're solving, and who else in the market is solving the problem, and how are you doing it differently? So I think what Eric's asking is one answer and a multi-answer question, right? So it's enough, but it's not all the answers you need to be able to sit here, right? I don't know if John or Manish want to add anything else.
It's a conceptual stage company and you haven't yet built the product, but you've got customers that are signing papers saying they're going to buy it when you build it. That's pretty strong. That's pretty nice. Obviously, we'd like to see a prototype in the hands of customers. And, any investor wants to see more. But that can be a differentiator for you. A lot of people don't have that.
All right, I'm going to turn to Kellen Lotta, who asks, what is your ideal return rate for your investments? 10 times? Something else?
Yeah, we talk about this a lot in our partnership. 10x is kind of the industry norm, kind of the cliche on, amongst venture investors, but, it's a pretty high stakes game. As much as you read about all the successes in the paper, there's not a lot of coverage on the failures, but they are happening and they always will. And so your successes have to overcome and pay back for the failures. And so 10x is a minimum. It's a minimum threshold. But if you're not opportunity limited as an investor, which most of us fortunately are not, we tend to try and think about 20x and aspirations for more. So this really just goes back to and a lot of entrepreneurs say, oh, well, that means you're going to be really tough on price, and that's not necessarily the case. It really means you have to be addressing a big problem where there are lots of consumers or businesses that care to have that problem, or an insight about a problem that is emerging that you think is going to emerge broadly, and so you have a big addressable market size, and so you still may get a really wonderful valuation, but if you can build plausibly build a $500 million outcome in terms of evaluation. So we're talking about unicorns lately in the press, $1 billion outcomes. And that's generally what institutional investors are thinking about. Angels, on the other hand, will think about something less. There's a lot more angel activity than there is venture activity in the United States. A lot more money there, and there are individuals that want to go after those smaller markets and niches, and that's a good way too.
All right, so I'm looking through these. Since this is on the same topic we were just on, why don't we do? You have relationships with angels to seek out investment opportunities. Are you essentially recruiting from them?
Oh yeah. Absolutely. I mean, angels are a strong part of a network. I mean, just like we look forward to Series B and Series C investors to come into our companies, with the wall of capital. Angels look towards us, to finance their companies that they've been looking at, right? So we have very strong relationships with the plethora of angels. And actually, Manish, interestingly, besides running his firm, often does angel investing, and we look at those companies as well, right? So the Valley and across the board is a very incestuous sort of place where these relationships are built over many years.
So the top ranked question right now, I'm going to put it on there. I'm not totally understanding the question, but usually investor build portfolio of same or similar domain startups for combined value. PR's got a couple of other questions. Put up the rest as well in case it was all somewhat combined. So first, you guys help provide a team, and is Inventus considering startups in WWW and entertainment domains? So those are all three questions there.
Well, I think if I understand that first question correctly, it's about investing in themes, and we definitely do that. Like I've mentioned, our broad feeling about the technology ecosystem is that it's moved to a new generation of services-led types of businesses. When was the last time we ever bought product? You buy your phone, you buy it on a services contract basis and get a huge discount that subsidizes it. Businesses buy their software as they use it month to month, year to year. They're not buying a special license anymore. These are all services models, and so we're very focused on trying to understand the application of those models in various sectors. And you get a lot of benefit from that as an investor, and hopefully your entrepreneurs get a lot of benefit from you as a board member, because then you build your networks and your understanding there, and you can hopefully add a lot of value in strategy, but also in recruiting. So going back to the other question about bringing a team, we don't drop in a team of our choosing. Some firms do. Some firms work really hard on having a bench strength of a team of operators, call them EIRs or what have you, that they can drop in. We tend to one of the things we're looking for is an entrepreneur that we think can become, public CEO. We want to back the people that can take it all the way. It doesn't always happen, but that's what we're looking for. So we really want to see the passion and the commitment from the leadership team in the founding team. And Manu, I don't know, maybe you want to take this one on WWW and Inventus or entertainment domains. Obviously, internet startups, and content startups and things like that, I assume.
Is WWW World Wide Wrestling or World Wide Web?
I wasn't totally sure either.
So I couldn't tell.
I'm assuming it's internet and content.
Yeah, but if it's the worldwide,
maybe we'll just take it from the entertainment. Yeah. The entertainment.
Well, entertainment comes in lots of different forms and shapes. And we've invested in a music startup that was sort of the Spotify and Pandora for Asian music that got acquired by RDO. We've done other companies in the space as well. I mean, and some may actually even argue that buying and selling stuff on Poshmark is addictive and very entertaining, right? And I'll let Manish sort of tell me about all the love that gets generated on his platform. I mean, my wife actually, goes to the mall or goes on Amazon now for retail therapy, and that seems to be very entertaining from what I can tell, right? So, um, sorry, so yeah, so to Kedar's point, yeah, we do invest in all those areas, and he did clarify. Looks like
Clarified
it is
as
a
well.
web. So I don't know, Manish, do you want to talk about?
In terms of your
Well, I
investment or
want
entertainment?
well, no, I was actually wanted to ask you more about team building. I know you built, from the two founders
Yeah, no, I did want to
to a
talk a
pretty
little bit
large
about the
team.
team. Yeah. So just wanted to say one thing is that if you can't really convince people to join your cause, then you need to either be pivoting your cause, changing it, or figuring out how do you explain your cause. Because being able to convince a group of people to follow you is one of the core tests of an idea, to a certain degree, from my perspective. One of the techniques I've used is what I call kitchen sink cabinet, which is to be able to get a group of people together in the very early days in a loose format till the idea strengthens and people can really get behind that idea over a period of time. And that's sort of what I used in my previous company, Caboodle, where we went through a 6 to 7 month process of getting people together, really building out, prototyping the idea, that almost everyone who was involved in it had a full-time job until we got to a point of conviction. And that's when I asked people to really leave their full-time jobs and commit to the idea. And it was sort of a different set of approaches on if you jumped in full time, sort of what was your equity compensation and how committed were you to the whole cause. But to me, really, there is no easy solution to building that initial team and initial product. And if you don't go through the hard process at that point in time, you can go through it later. So inculcating that team, building it out, sort of making sure that all of you are working together, even if you are best friends, even if you've sort of worked together in a company before, this process really starts to separate out how you're going to work in a startup, which is a pot boiler kind of situation. So building out the team is a very, very core thing, even as you take your journey as a startup.
Wanted to get to this question from Irving, who asks, how important is market penetration segmentation when pitching your idea for seed money, and how would you go about saying that in a pitch?
So you said the questions for me or for John? I couldn't
Either one
hear
of you,
that.
Manu, if you want to take it.
Okay. Yeah, I mean, the market sort of segmentation and overall market sizing is part of the overall thing, right? You could have a really good market segmentation, but you don't have a product that actually fits the bill, then that's a moot point. So I think it is important. It's one of the many ingredients that go into making the complete sort of package, right? So I mean, some entrepreneurs are really good at doing this, and others are not, and that's not a ding or a plus against you, right? So it's like cooking a meal, right? I mean, can you say salt very important in cooking a meal? Yes, it could be. I mean, the entire thing could be, would not be palatable, but it's not but if you forgot to put the chicken or pork in it, then it doesn't matter how much salt you had in it, right? So I would sort of throw this question back and sort of saying it's sort of thinking of this holistically from every single angle, right? As Manish mentioned earlier, he had a very strong technical and product mindset, but needed the ingredient of somebody in the fashion space to actually build credibility and having the deep insights that it requires to be able to build that, right? And that's, so he realized that that's what was missing, and he went and filled that gap, right? And I think just like any business plan or any sort of idea, you have to sort of figure out what things you don't know and how do you sort of fill the gaps up, right? And segmentation is one of 10 things you need to worry about.
We have 2 questions from Lawrence. I'm going to put them both up. One of them is, I want to say funny, but it's understandable. He says, my wife told me that my idea will not fly because I don't have investors. What should I do? Listen to her or send her packing or totally ignore her? then in a separate question, he gives us a little more information about his startup. It is, we have a SaaS software product. It's software that can be made compatible with several types of businesses. We have the prototype ready. Members of my team are located in the USA, Japan, and India. We are looking for investors. How can I reach you? Which I'm sure actually a lot of people watching this webinar are wondering. So a lot of different questions there.
So Laura,
Manu, I have your number. Should I publish it?
yeah, you can. I was about to. So, well, actually, Lauren, since you made me laugh, I'll give you my email address. It's manu@inventuscap.com. So happy to look at your business plan. But I think your previous question actually does touch a nerve as well. So when I was leaving Google, my mom, my wife, and I don't know how many other people told me I was completely idiotic to leave, especially when Lehman's Brothers had just collapsed 2 months earlier. So it is hard. I mean, and the thing is, you end up then working 18, 20 hours a day. You don't have time to do anything else with your family. But that's what it takes. You get the conviction to be able to do so, right? And whether you have investors, you have your savings or your 401k that got put into it. Those are all risks that you take to make sure that you can achieve those dreams. Because it's you rather do it than regret doing it. And it's not unlike your spouse or your friends or your parents to do this, because they're looking at after your well-being, and having a steady long job is what 99% of the population does do. So it's not anormal. What you're doing is anormal, and it does require some level of craziness to be an entrepreneur. But if you have the belief, you have the conviction and the passion to make the idea work, you'll find a way to sell. I mean, the hardest, and just to reiterate, John mentioned, as an entrepreneur, you're always selling. You're selling your co-founder, you're selling your investor, you're selling, LA Times on to get your story published, right? You're always selling, constantly selling to everyone. And you have to sell to your wife and to your mom and to your kids if you have them as well, right? So whether you have a marketing background or engineering background, you are a salesperson when it comes to being an entrepreneur, right? And so I would suggest you not to throw your wife away packing, because you need that support as when those dark days come running your company, and they will. And Manish can tell you something about how much you have to sell your spouse, especially when you're doing a second startup as well, right?
Yeah, I think really thinking through in the early days, the biggest fear which people had is, what happens if I lose everything I have? What is sort of the opportunity cost? What's happening? And I think as you think it through, it's very important to discuss it with people who are dependent upon you, or you're dependent upon them, or there's sort of cross functionality in people. So one of the things that we went through as an exercise is, how much cash do you have in the bank? Sort of how much money are you going to spend, and how many months can you survive in the current situation? The answer really varies. If you are married, you have kids, you have mortgage, then it's a different answer. If you are young and you can lunch with your parents, or sort of live in a single room kind of a thing, it's a different answer. But having sort of a worst case scenario in mind, where you say, I'm going to give it a year, and at the end of the day, I may burn through all of my savings, but then I can go get a job and sort of rebuild the savings. Some sort of a vision of that is critical in order to take risk. If you're taking risk and you're sort of thinking that in 2 months I'm going to get funded and everything is going to be hunky-dory, then you're probably likely to not be able to go through the journey that is required. But if you think that it may take me 12 months before I get funded, and here's sort of my plan for the next 12 months, the possibility of you actually succeeding goes up dramatically. You may actually get funded in 2 months, but if you thought through that 12-month dark scenario.
We have about 5 minutes left. I want to try and get through as many of these questions as possible. John, do you mind answering this one? What metrics do you look for in SaaS startups at the seed round? He writes it.
Yeah.
If we have a premium product ready and have a few active customers.
Well, at the seed stage, the metrics are pretty thin, right? As described here, particularly, you got a few customers, and that's good. But really, that hopefully is articulating an example of on a proof point of the vision of the company versus, say, metrics. Metrics would imply, a lot more certainty around, extending and extrapolating into the future. So, this goes back to, being able to, articulate, this prior question about, segmentation, all that. It sounds very business school, very MBA, but the bottom line is you want to be able to articulate the problem you're trying to solve and why you're solving it better than anybody else and why it's possible for you to do it better than anyone else. And if you have a few customers that are also taking advantage of that and can talk about that and how it's really made a difference in their business, their lives as consumers, depending on what kind of business it is, then that's wonderful.
And, I mean,
but I don't know that it would go to the step of being metrics.
And I was just going to add, I mean, for people interested in one day getting their companies covered by newspaper, that's pretty similar to what we look for as well. How is it making a big difference in the lives of everyday people? Just kind of the bigger picture, more, I guess, like a broader scope. This is, again, from Callan. If your portfolio investors put something on the plate, is it a guarantee that it will be funded, or does it still go through the decision-making between the two of you, Manu and John?
If our portfolio investors put something on the plate, I assume that means a portfolio company. I'm not quite sure of the question, but generally, from our decision-making process, we try to keep it simple, but it is consensus. So it's not just Manu and I, but it's our four other partners in our firm. We all meet the entrepreneur and the team and hear about the business plan. There'll be one or two of us that's on point that does most of the interaction or work on it and will champion it through our process. But if we can't, I mean, we look at it similarly to this other question about, convincing your family. If we can't convince each other that it's an interesting opportunity and a great team and a great company, then we must be missing something. So if someone has, significant reservations about a given company or team, then that will generally not get financed by us. And that's the same with follow-on financings. If this is about follow-ons, if a company isn't performing or that sort of thing, we've got to make some hard decisions too. But so it's not there are no guarantees in life, but it's a high hurdle to step away from a company back to a team.
I'm going to take this last question, and then the other few have to do with contacting you guys and pitching a specific product. But this one, sometimes we see the product is liked by users. We see some market validation also, but to scale it up, you need money from marketing. So how to deal with it? So I think the answer or the question has to do more with when you're a small company, is it worth it to funnel a fair amount of cash into marketing purposes?
Yeah, that's always the problem.
Actually, Manishi, do you want to take?
Yeah.
How do you feather that in?
I think typically people overinvest in building the product and underinvest in getting out and touching customers. So I think investing in something that actually gives you customer validation, customer traction, and building it out makes sense. How you do it is very, very different. I mean, throwing money at the problem is often the wrong approach, but not focusing on it and spending money on it is the wrong approach also. So you could hire people. For example, for us, our initial customer traction came through a lot of physical events, which is kind of the antithesis of online marketing. My co-founder, our head of community, physically visited many of the local fashion events. We used to hold a happy hour every other week in San Francisco. We flew out to LA. We hosted events at boutiques and literally gathered up the first few hundred users through that high-touch process. So we didn't throw hundreds of thousands of dollars in marketing, but we spent a fair bit of time thinking about how do you go and get those customers. And that approach can be very different for different industries. But thinking about how you touch the customers, how you get that, how you sort of scale the initial traction is very critical. And definitely the answer is not taking out a Super Bowl ad.
All right. So think we're going to end there, but Manu, if you could, the last two questions have to do with what is the best way to contact you. So if you wouldn't mind repeating your email address, and it looks like Anita wanted to maybe talk to you about her SaaS software products. It was Manu at.
Sure. Manu at inventuscap.com. So if you go to our website, you can also there's an email link for info@inventuscap.com. John and I are both available on LinkedIn as well. But I think, as John mentioned, the best way to reach us is actually finding somebody in common with us, right? But obviously you've already found something common because you've been on this webinar, so I guess you get to bypass that process.
Thank you all for doing this and for inviting me to be a part of it as well. And it's exciting. I'm sure you guys will be hearing from a lot of viewers. So thanks a lot.
Well, and Andrea, thanks for taking the time. And Manish, I know you're busy selling lots of women fashion.
I keep looking at that bag on your shoulder.
Thank you.
Thanks.
Thank you.
Bye.
Okay.
Okay.
All right. Take care.